This video is for educational purposes only and is not professional financial advice. Do your own research before investing. Axon Enterprise, ticker Axon. A company that started by putting electrical deterrence in the hands of law enforcement and has since built one of the most quietly powerful ecosystems in public safety technology. The question driving this entire video is simple but not easy to answer. Is Axon actually capturing its market? And is the market pricing that correctly? Because with revenue growing at roughly 34% year over year and a business that spans hardware, cloud software, and real-time intelligence tools, this is not a one-product story anymore. What you are about to see is a full breakdown: the market opportunity, the acceleration in the growth numbers, the competitive durability baked into the business model, the unit economics at scale, and finally whether the valuation reflects what this company is actually becoming. The growth flywheel is already moving. The only question is how fast. The aerospace and defense sector rarely produces software-driven recurring revenue businesses. But Axon is exactly that. Law enforcement modernization is a secular tailwind with no visible ceiling. Agencies worldwide are under pressure to digitize evidence, improve accountability, and deploy smarter tools in the field. Every body camera sold is a gateway to cloud storage contracts. Every fleet system installed deepens the platform relationship. That structural dynamic is showing up clearly in the revenue trajectory on screen. From $807 million in the most recent quarter alone, with the prior three quarters coming in at $668 million, $710 million, and $796 million. This is not lumpy project-based revenue. It is a consistent compounding climb. Each quarter materially outpaces the one before it, reflecting accelerating platform adoption rather than one-time hardware cycles. The stock currently sits at $593.96, roughly in the middle of its 52-week range between $339 and $885.92. That positioning suggests the market is neither euphoric nor dismissive. It is watching. And with revenue per employee running at approximately $545,000 across a workforce of around 5,100 people, Axon is generating significant output per head, a signal of operational discipline. The forward question: can this platform continue expanding into agencies and geographies at the same velocity or faster? Here is the signal that separates Axon from most growth companies. The growth rate is not holding steady. It is accelerating. That is the flywheel spinning faster, not just continuing to turn. Go back to the second quarter of 2022, when year-over-year revenue growth clocked in at 30.5%. By the fourth quarter of 2022, that rate had surged to 54.5%. The pace moderated into a steady corridor through 2023 and into 2024, ranging from 28% to 34%. But the base was growing the entire time. Then look at what happened in the fourth quarter of 2025. Growth re-accelerated to 38.5%. The most recent quarter, the first quarter of 2026, posted 33.7% year-over-year growth on a revenue base of $807 million and $35,000. In absolute terms, Axon went from $218 million in quarterly revenue in mid-2021 to over $807 million today. That is nearly a four-fold increase in the revenue run rate over roughly 5 years, while the growth rate itself is climbing, not fading. This is not a maturing story with decelerating momentum. This is a company where demand is compounding faster than the base suggests it should. The next question is whether the business model underneath that growth is durable enough to sustain it. When there are no obvious peers to benchmark against, the business model has to speak for itself. And Axon's financial scorecard makes a strong case. Start with gross margin, 59.7%. For a company that sells physical hardware alongside cloud software, that is an exceptionally high margin structure. It reflects the platform economics at work. Once an agency is inside the Axon ecosystem, the incremental cost to serve them is low, and the software layer commands premium pricing. The slight compression trend, margins have moved down roughly 1.9 percentage points over 5 years, is worth monitoring, but it does not undercut the structural advantage. Hardware mix and investment in new product categories can explain modest pressure at this growth velocity. The Rule of 40 score sits at 36, approaching the benchmark that top-tier software companies target. A score of 36 means the combined weight of revenue growth and profitability metrics is substantial, and the trajectory suggests it is moving toward, not away from, that 40-point threshold. Critically, Axon is free cash flow positive. There is no capital destruction funding this growth. The business is self-sustaining at scale, which is the clearest signal of genuine economic durability. The revenue momentum chart reinforces this. 8 consecutive quarters of revenue growth, no air pockets, no reversals. Demand is not episodic, it is structural. The verdict on competitive durability, based purely on these fundamentals, is that Axon has built a moat worth taking seriously. Unit economics tell you whether a business is getting stronger or weaker as it scales. For Axon, the picture is mostly constructive, with one trend worth watching carefully. Gross margin has run between 59.5% and 61.5% over the past 5 years. The 2021 peak of 61.5% has gradually compressed to 59.7% in 2025. That is a real, measurable trend. Not catastrophic, but not dismissible either. In a business where software should theoretically carry higher margins over time, the compression signals that hardware mix, product investment cycles, or channel costs are exerting some downward pressure. Investors should watch whether this stabilizes or continues. The Rule of 40 score of 36 2/10 is encouraging. It means that even accounting for the margin pressure, the combined growth and profitability profile remains strong. The gap to 40 is closable if margins stabilize and growth holds. Revenue per employee, approximately $545,000 across 5,100 employees, is a meaningful operational leverage signal. At this revenue per head level, Axon is generating scale output without bloated headcount. The question going forward is whether that ratio improves as revenue compounds, or whether hiring accelerates to match new product build-out. On valuation context, the current price-to-sales ratio of 16.4 times sits exactly at the sector median. For a company growing at 33 to 34% with positive free cash flow, that raises an immediate question. Is the market appropriately pricing this growth, or leaving something on the table? The price-to-sales history panel tells a story of a multiple that has moved through distinct chapters. Axon traded at 12 times sales at the end of 2021, compressed to 9 9/10 times through 2022 as rates rose, recovered to 12 3/10 times in 2023, expanded sharply to 21 6/10 times in 2024 as growth reaccelerated, and has since settled back to 16 4/10 times, exactly at the sector median. That pullback from the 2024 peak is what creates the current valuation setup. Now look at the valuation meter. The price-to-sales to growth ratio, PS divided by the revenue growth rate, sits at 49 hundredths. A ratio below 1 means the market is paying less than $1 of multiple for every percentage point of annual growth. At 49 hundredths, investors are paying roughly half a multiple point per point of growth. For a company compounding revenue at over 33%, that reads as underpriced relative to the growth rate being delivered. The revenue growth trend chart confirms the growth acceleration rather than decay. The rates have been climbing, not fading, which strengthens the case for the current multiple. Gross margins holding near 60%, despite modest compression, support a premium multiple over commodity industrials. The Rule of 40 score of 36 approaches the threshold where top-tier software multiples are typically justified. Against analyst consensus, the forward revenue scenarios for 2027 range from $3,350 million on the low end to $4,090 million on the high side, averaging $3,720 million. At the current market cap, that implies a forward price-to-sales ratio of 12 9/10 times. Bull case, multiple expansion to 19 7/10 times if growth accelerates beyond expectations. Base case, 16 4/10 times if execution continues on its current track. Bear case, compression to 11.5 times if growth decelerates or the rate environment tightens. 3 risks and 3 catalysts define the investment thesis from here. Multiple compression is the most immediate risk. Axon trades at 16 4/10 times sales, and growth stocks at this multiple are acutely sensitive to interest rate shifts and broader sentiment reversals. A re-rating could happen independent of business performance. Gross margin compression is a slower-moving risk. The 5-year trend from 61.5% down to 59.7% is modest but real. If hardware mix continues to drag on margins, the Rule of 40 score will struggle to reach the 40-point threshold and the valuation case weakens. Competitive and regulatory disruption is a structural risk in public safety technology. New entrants with AI-native platforms or shifts in government procurement policy could pressure Axon's ecosystem lock-in faster than the current growth rates imply. On the catalyst side, platform deepening is the most powerful lever. Every new agency that adopts body cameras, cloud evidence management, or real-time response tools expands the recurring revenue base with low incremental cost. International expansion represents a largely untapped growth vector. Domestic adoption is maturing, but global law enforcement modernization is still early innings. New product categories, including autonomous devices, drone integration, and AI-assisted evidence analysis, could expand the addressable opportunity meaningfully and re-rate the multiple higher. Here is the verdict. Axon Enterprise is a growth buy. The bull case is straightforward. A business growing revenue at 33 to 38% annually, free cash flow positive with a price-to-sales to growth ratio of just 49/100ths is not being priced like a category winner. The market is offering a sector median multiple for above-median growth, and forward analyst consensus implies a price-to-sales ratio of only 12.9 times on 2027 revenue. That is room for meaningful appreciation if execution holds. The bear case is real. Margin compression continues, rate-driven multiple compression hits before growth re-rates the stock higher, and the gap from 36 to 40 on the Rule of 40 never closes. But the weight of the evidence, accelerating revenue, positive free cash flow, deep platform lock-in, and a valuation sitting at the sector median despite superior growth, points toward a market that has not yet fully priced what Axon is building. If you found this analysis useful, subscribe for more data-driven breakdowns. And if you are tracking Axon, drop your take in the comments, bull, bear, or somewhere in between.